Welcome to this explainer. Today, we're going to untangle the absolute mess of a market environment we're living through right now. Seriously, if you've been watching the markets lately and feeling like things just flat out don't make sense anymore, trust me, you are not alone. There are massive, unseen tectonic plates shifting right beneath our feet, and today we're going to map them all out. Just think about this massive 32.9% performance gap for a second. On one side, you have enterprise software giant Salesforce, absolutely soaring. But on the exact same day, legacy consumer staple Hormel is sinking like a stone. That is an incredible chasm for a single market session. To understand just how fractured things are right now, you really have to realize that this isn't your normal run-of-the-mill volatility. No, this is a structural break. What we're actually watching is a market ecosystem literally tearing itself apart, caught in this brutal, high-stakes tug-of-war. On one end, we have this unstoppable, high-tech euphoria, just pushing things higher and higher. But on the other end, there is a deep, shadowy, and super volatile macroeconomic policy void, pulling everything right back down. It's a massive collision of forces, and navigating it is going to require a completely new playbook. So, here is our roadmap for today. We'll start with the Great Divergence, move into the AI micro engine, tackle the macro policy void, look at the casualties of this tug-of-war, and finally wrap it all up with a strategic playbook. Okay, let's jump right into part one, the Great Divergence, a market tearing itself apart. It's wild when you look at the numbers. Information technology is literally the only sector out of all 11 S&P categories actually gaining ground right now, up 3.4%. You've got Salesforce up 22.6% and NVIDIA up 8.7%. But then, scan across the rest of the market. Consumer staples are bleeding, down 1.5% overall, and Hormel dropped over 10%. And what's really crazy is that even former tech and growth darlings aren't safe. Marvel sank pre-market despite beating earnings, and PayPal absolutely cratered by 14%. The rising tide isn't lifting all ships anymore. It's only lifting very, very specific ones. Moving on to part two, the AI micro-engine, the unstoppable push. Let's look at the first massive force defying market gravity right now. You want to see the sheer horsepower of this movement? Look at this gap. FactSet analysts were expecting a respectable 45% ceiling for NVIDIA's revenue acceleration. Pretty solid, right? Well, NVIDIA came out and completely shattered that consensus, issuing a 70% growth guidance for fiscal 2028. But you know what the most crucial takeaway here is? It's not just the big number. It's the reality that this 70% ceiling is dictated entirely by supply constraints, not demand. They literally cannot build the hardware fast enough to satisfy the market. And this aggressive push? It's fueled by the absolute unshakable optimism of industry leaders. Take Jensen Huang, NVIDIA's CEO. He's openly predicting net job creation at an unprecedented scale, boldly pushing back against prominent skeptics. This isn't just standard corporate PR speak. This is a deep, fundamental belief in a generational platform shift, and it is driving massive capital allocation. Now, this leads us into the next critical phase, the pivot from hardware momentum straight into software integration. For a while, there was this huge fear of software obsolescence, right? The idea that AI would just replace traditional SaaS tools entirely. But instead, we're seeing a powerful merger. When you take frontier AI models like Anthropic's Claude and combine them with enterprise data and workflows like Salesforce, you get what the industry is calling CloudForce. It positions enterprise applications as the secure, trusted foundation for AI access. That completely reversed those obsolescence fears and directly drove a 7.4% surge in the software sector ETF. All right, that brings us to part three, the macro policy void, the shadowy pull. Because while the tech sector is sprinting toward the future, our second force is dragging everything else into a highly volatile void. This creates a super delicate, frankly dangerous balancing act. Picture Fed Chair Warsh at Jackson Hole, essentially staring blankly at a wall. On one side of the scale, you have sticky, decelerating inflation and a steepening yield curve. On the other side, the market is practically begging for forward guidance. And in the middle, Warsh is using deliberate taciturnity. He is highly intentionally staying silent, giving zero forward guidance. As Boston Fed President Collins recently pointed out, this creates massive risk, especially if inflation stalls. That lack of communication is a high volatility risk in itself. But you know, that silence? It's masking an unprecedented structural shift happening right under our noses. The the clashing mandates of the Federal Reserve and the U.S. Treasury. On the Fed side, Warsh has to manage inflation, employment, and crucially, shrink the balance sheet. But look at the Treasury side. Secretary Bessent has a completely different mandate: fund government debt and manage rising yields, especially now that foreign ownership of our debt is dropping down to 40%. These two mandates are on a direct collision course. And that overlap, it creates what we're calling the conflict zone. The Treasury is straight up encroaching on traditional Federal Reserve territory. We are seeing a wild blurring of administrative lines, which leads to highly unusual market operations like 30-year security buybacks and liquidity coverage rule interventions. The Fed desperately wants to tighten things up, but the Treasury desperately needs liquidity to fund the government. Which brings us to a frankly brilliant, if controversial, workaround: the Trojan Horse Liquidity Accord. This is how bank regulatory reform is quietly reshaping the bond market to address $326.7 billion in unrealized losses. Let's follow the loop. Step 1. Looser bank regulations mean the Fed discount window suddenly counts toward liquidity coverage rules. Step 2. This magically unlocks between $500 billion and $1 trillion in lending and buying capacity for banks. Step 3. The Treasury swoops in and absorbs this freed capital as banks use it to buy short-term Treasury bills. Step 4. Scarcity is created. The Treasury sells bills instead of bonds, long-duration paper gets scarce, and the Fed is still technically allowed to shrink its balance sheet. It is a brilliant closed-loop system designed to quietly print liquidity. When you break this accord down, it's creating a huge structural divide in the banking sector. The primary beneficiaries? The liquidity-heavy institutions. Places like Bank of America, U.S. Bancorp, Truist, and Capital One are perfectly positioned to leverage this freed capital. On the flip side, the losers are the liquidity-light banks, like Flagstar, Western Alliance, and Bank of California. They get marginal or zero benefit and remain structurally constrained no matter what. The big get bigger, and the vulnerable stay vulnerable. Part 4. Casualties of the tug-of-war. Prefer-free shifts. So, what happens to everything else caught in the crossfire of this massive collision? Well, when the center is this volatile, things at the edges start acting super weird. Take the biotech sector. Traditional structural moats are just evaporating right before our eyes. We used to live in the old era, where Western biotech had a massive moat. Discovery led to a decade of patent-protected trials and huge monopoly profits. But look at the fast follower era today. Western Phase 1 data is immediately taken to Chinese hubs, re-engineered, pushed through cheap trials, and rapidly licensed globally to challenge original creators. The takeaway here is absolutely vital. If scarcity disappears, valuations have to drastically adjust. We're also seeing these bizarre sector anomalies where value is hiding in plain sight, but completely ignoring traditional market logic. Look at defense dislocation. L3 Harris is actively tanking. Why? We have two major global conflicts and skyrocketing demands for missile rearmament. The bullish fundamentals are totally intact, yet the stock is plunging. Conversely, look at retail resilience. Gap Inc. is surging 15% pre-market, totally bucking the consumer staples weakness that dragged down Hormel. It just proves that in a fractured market, idiosyncratic micro-stories can absolutely overpower broader macro trends. Finally, Part 5, the strategic playbook, navigating the collision. How do we actually synthesize all these conflicting forces into an actionable roadmap? Based on our analysis, your asset allocation really needs 3 distinct pillars right now. First, the yield play. Look at the flattener trade. Because the Treasury is soaking up that Trojan horse bank liquidity with short-term bills, long-duration paper is becoming structurally scarce. Expect 30-year yields to drop faster than 5-year yields. Second, the macro hedge. Go long gold and short the US dollar. You need protection against the bumpy landing coming from that crazy jurisdictional conflict between the Treasury and the Fed. And third, the growth anchor. Stay long on foundation AI. You want to maintain aggressive exposure to supply-constrained hardware leaders like NVIDIA and integrated enterprise models like Salesforce. But here's what you really need to be watching on the calendar right now, because this coming Friday morning, it is an absolute powder keg. At 10 a.m., Fed Chair Warsh takes the stage at Jackson Hole. That brings massive volatility risk depending on whether he finally drops the silent treatment and gives forward rate commentary or if he just stays quiet. Alongside that, we've got the Chicago PMI release gauging industrial resilience and the University of Michigan final outlook, which is a critical gauge for sticky inflation. With all this data crushing headfirst into a silent Federal Reserve and an overextended Treasury, the ultimate question you have to ask yourself is, which force is finally going to snap the rope in this market tug of war?